Mortgage rates have climbed to their highest level in 3 months. And you might now be wondering, is it right for me to buy, to refinance, or do anything mortgage related? Watching this video is going to help you answer those questions. All right. Rates are up, rates are down. It's a constant conversation. Filming this in late May 2025. Mortgage rates tipped up to that 6.99 range, about an eighth of a point higher than they were just a few weeks ago. So we're seeing small incremental changes, but the trend right now is trending back up. We are still down below where we were in early 24 and in 23, but still staying in that high 6% range. At a super high level, what does this mean to you as a person buying a house and getting a mortgage? Not a lot at the end of the day. An eighth of a point really isn't a reason to buy a home or not buy a home when you strip it down. So purchase mortgage applications fell in the last few weeks by about 5%. That's someone looking at buying a new home. When I say a new home, I mean new to them. That's existing home sales. That's also new construction. Refinance applications also fell about 5%. All that said, overall purchase applications year over year are up. And they're up in that 13 to 15% range year over year. So despite interest rates creeping up a little bit, guess what? There is pent-up demand out there in the market. People have continued to wait to move into the next house. They've continued to wait to move into a smaller house. They've continued to wait to move into a bigger house. But at some point, that pent-up demand is starting to show its head, and that's why we see increased activity year over year. And I think that's a trend that's going to continue regardless of interest rates. So what's the underlying story? Why are interest rates moving, and why are they moving up right now? What's the reason for the recent volatility? In nearly 25 years in mortgage lending, the one constant that I've seen in tracking mortgage rates is watching the 10-year treasury. In watching that 10-year treasury tick up and tick down, mortgage rates typically move lockstep with that. And we've seen the 10-year treasury moving up in recent weeks. The big reason for that is a handful of things: inflation concerns, potential downgrading of U.S. debt and credit rating through Moody's, and federal debt levels. Our debt continues to go up and up and up. Now, I'm not a huge advocate of these credit ratings. I think they're manipulated. I think they're political. I think a whole variety of things. So I take that with a grain of salt. But stepping back and looking at the 10-year treasury, those three things are probably the biggest thing that's driving that up currently. Now that you get an idea of treasury rates and mortgage rates, let's talk about what that really means to you as someone that's getting a mortgage. Take a $400,000 loan as an example. Not a $400 purchase price, just a $400,000 loan. Let's take all the variables out of it, whether you're putting down 30% or 50% or 5%, or you have mortgage insurance or you don't have mortgage insurance. Just the loan itself. If you were borrowing $400,000 at a 6.99% interest rate, compared to borrowing $400,000 at a 6.5 interest rate, a half percentage point move makes a whopping $130 difference in payment. I can tell you, if you're looking at a $400,000 house and it really comes down to whether you're going to buy it or not for only $130, maybe you shouldn't be buying a house, put bluntly. Little moves in interest rates do not make big differences for most people. It's a lot of perception. Stripping that down and understanding those numbers at a very high level, I think, is critical when you're looking at payments. Don't get me wrong. $130 looks better in your pocket than anyone else's, but we all know most people can find $130 in their household budget if they're looking at a $400,000 purchase. So let's talk about refinancing. There are a number of people who bought homes in recent years and maybe were in that higher 7% price range. When I look at refinancing, if your goal is just a lower payment on a $400,000 loan, my professional opinion is I'd like to see you save at least 1 percentage point. If you are at a 7.75% interest rate, I'd love to see you look at refinancing no less than 6.75%, 1% move. The other big piece with that, if you choose to refinance, it's very important to keep your cost very low. Some lenders will push paying points to get to 6.5 or paying additional fees to get a slightly lower interest rate. I have a very different opinion on this, and I feel very strong about it. I feel strong about it because I lived through a big refinance move 20 years ago when interest rates from 7.99%, everyone was so excited that rates had dropped from the 8s down into the high 7s. All of my clients refinanced with very low fees. They refinanced again at 6.99%. And a couple years later, they refinanced again at 5.99%. And a couple years later, 4.99%. And a couple years later at 3.99%. And some got all the way down to 2.99%. When you refinance and keep your costs low, you're able to recapture the cost associated with refinancing in a very short period of time. That then allows you to move if and when interest rates drop again. Now, just because they don't come out of your pocket, they still are costs that are oftentimes tacked on top of the mortgage. So pay very close attention to that. There's another piece that many clients are looking at refinancing, and what it's related to is all this equity that's continuing to build in their house and in the home that they own. House prices continue to go up, values go up on a house. So many clients have a lot of consumer debt. Consumer debt has been mounting and building and more and more and more. And they look at this home of theirs and it may have several $100,000 of equity in that house. Some people choose to tap into that equity to pay off debt. If you do tap into that equity and pay off debt, be really cautious. You don't want to treat your house like an ATM where you're just hitting it every single time and pulling money out. I want my clients to build that equity, eventually get to a home that they own free and clear. But there are times and places where maybe it makes sense. So looking at a couple of the experts out there and what's expected to happen with mortgage rates, Fannie Mae had recently said they expect rates to be in the low 6s toward the end of this year. Mortgage Bankers Association, I believe, so they predicted something in the 6.6 range. So wow, huge range between these two quote-unquote experts. Many of you may have bought a home in the last several years and that lender said, I'm sure rates are going to be lower next year and they're going to go down, and you were promised something that just couldn't deliver on and no one knew what was going to happen. I feel the same way when I listen to these quote-unquote experts. No one really knows what's going to happen. In my professional opinion, I do see interest rates coming down over a longer period of time. Is it this year? Is it next year? Is it the following year? I don't know, but I do feel that that trend is heading in that direction from all the information that I look at in my time in the mortgage business. I do not expect in my career to ever see interest rates back to where they were a few years ago in the 3% range, even high 2s. Do I think we could see things in the 5s? Absolutely yes, and I think there's a good chance in the next couple years. I'm always a guy who hopes for the best and plans for the worst. So get into a mortgage that you feel comfortable with your payment and the rate it's at, and don't assume that tomorrow it's just going to drop and it's going to be more affordable down the road, because that is not guaranteed. So sticking with that, if you're still out there looking for a house, I want to give you some really good advice that I feel helps people really understand what payments are going to be and getting a strategy to buy a home. First thing is, get pre-approved early. So often people go out and find the shiny object, the house they want to buy, then they figure out how to pay for it. I really advise people to have that conversation early, to get pre-approved and see what you can afford ahead of time. Not just get pre-approved, understand what a payment would be for a house in the price range you're looking at. If you're looking at $500,000 homes with a 10% down payment, what does that payment look like? With taxes, with insurance, home insurance, with mortgage insurance. What is that all-in payment? Because there's nothing worse than finding a house you fall in love with only to find out you're not comfortable with the payment. Just because the mortgage professional said you could afford it, do you want to afford it? Do you want to feel like you're just surviving to pay your mortgage payment? It's not a good feeling, so understand those numbers first, I think is critical. The next thing in that conversation, understand a range. We talked about earlier a 0.5 percentage point move on a $400,000 mortgage was only around $130. Understand what your payment looks like $130 higher, $130 lower, a 0.5 percentage up, a 0.5 percentage point down. Understand those numbers. The mortgage payment itself, paying back the loan, is only one factor in your payment. Homeowners insurance is up across the country, higher in some areas, but almost higher everywhere. Property taxes. What are the property taxes today in that property? But the next level question is, what are the property taxes going to be after my house gets reassessed? Have a really good understanding of those numbers and understand interest rates up and interest rates down. Rates are moving. Guess what? Rates always move. Rates always move up. Rates always move down. What that doesn't mean is you need to panic. What you need to do is plan. If you want a second opinion from a true mortgage professional, I would love to connect with you to help you understand your numbers, understand options, and be a well-educated customer buying a new home.